rates going up doesn't mean you're going to make more money. When interest rates are going up, bonds are going down. There's an inverse relationship there. As interest rates rise, your bond price falls because new bonds that are being issued after rates have risen earn more money. So clearly a new investor will want to buy those new bonds as opposed to the old bonds. Over time, those bond prices will adjust to make sure that the yield or the coupon earned over time is the same. The explanation for this is actually fairly simple. New bonds that get issued after interest rates rise are going to be worth more. So the old bonds with the lower coupon are going to go down in price. But not all bonds will go down by the same amount. Bonds with a longer term to maturity are going to be more sensitive to interest rate changes because it's going to be a longer time until you get back par or the maturity value. Shorter term bonds will be less affected by interest rate changes because they're going to return that par value sooner. But how do you know what interest rates will do next? Will they rise or will they fall? That's like asking what the stock market is going to do next. Over long periods of time, people can estimate what interest rates will do, but there's a host of factors and variables that account for changes in interest rates. The Federal Reserve is probably the most important factor. They've recently suggested that they're going to pivot towards cutting interest rates over the course of this year. However, we don't really know how many times they will cut or even if they actually will cut. Instead, think about investing for the long term. By buying a bond today with a long maturity date and a high yield, you are locking in that coupon for a number of years. Individual bond positions are typically held to maturity for those very reasons. Today, you can lock in 6% yields on investment-grade corporate bonds. I like to call those set it and forget it positions in my portfolio.